There's 4,000 members of the industry here this week. Is that for you an indicator of this industry needing to come together to kind of face these quite considerable challenges in the environment at the moment?
Well, thank you very much for inviting me to join. Super Return's been going for a long time, as you know, and I think what it is it's a great, as you pointed out, gathering place for people to compare notes, show some anxiety from time to time, and try and look ahead. I haven't been for a little while, mainly because of my change in role, but also COVID to some extent got in the way. But it's a great opportunity for us to come and take the pulse of the industry. We feel, whilst we're an active participant in private equity, we've also got some innovation and different solutions that we can make available. So we're partly here as well to make sure we try and share that with private equity firms who may be able to work with us.
You definitely see yourselves as a plan doing things differently, don't you?
We do, and that's partly because we were one of the pioneers of the Canadian model. We were first out the gate in 1990. Really sponsored by the provincial government in Ontario. We also see ourselves different because we've been investing internationally for a really long time, particularly in alternative assets. So you'd have thought for a pension plan, it's all about equities and bonds. Well, we only have about half of our portfolio in those two categories. And even within equities, about 70% of it's in private equity. So we're very light on public equities. We see some risk there in the market at the moment. And we've also tried to be very agile, particularly since I took over. I mean, every year's been a bit of a surprise, it's fair to say. But we've tried to be agile in moving into areas where we think we can make better returns. So we came out of bonds to really move into inflation-sensitive assets. So that's really for us has been commodities, natural resources, and also to some extent things like infrastructure where we can pass on changes in inflation because that's built into the arrangement.
Tell me a bit more about that, why you've chosen and highlighted those specific sectors that you've settled on as the best place to be at the moment.
Sure. Well, if you look at 2022, I think we were one of only 2 investors who made a positive return internationally. So without gloating about that, the learning point for us was the reason we were able to do that was we very consciously moved out of fixed income, moved out of some of the more difficult areas of public equities, and then over-allocated to things that would perform well in an inflationary market. So there's some of the areas I described, commodities, gold, natural resources, I think gave us almost a 40% return last year. But at the same time, if you think about what we do intrinsically, we're a large defined benefit pension plan. So inflation is one of our biggest enemies. And whatever we can do to mitigate some of that inflationary risk, we should be very much on that.
What do you think are the key things to mitigating that risk at the moment? And where do the greatest risks lie?
Well, you can't mitigate everything in life, so we try our best. I would say we've been able to do it quite well in some of the private product categories. Some of our avenues for inflation-linked bonds have been sort of made a little bit more difficult. So one of our questions is we also like to have a bit of a balance between overseas currency and Canadian currency. So like real return bonds in Canada was stopped recently, which means we've had to look elsewhere to try and get some of that inflation coverage. But I would say for us, what we also try to do thinking about inflation is say, what does that mean for all the businesses we invest in? So it's a lot easier to be a successful investor if you back something with tailwinds rather than headwinds. And some businesses at the moment will find it actually just really difficult to live through high inflationary environment. So as an illustration of that, maybe, we are a little less fond of consumer than we were because we see that as a sector that's going to have inflationary challenges probably over the next 18 months. We haven't seen all of that yet.
It's a more discretionary sector.
Yeah, so we would expect a consequence inflation to be with a high interest rate environment that as mortgage rates bite and continue to be more expensive, discretionary spend will eventually dry up. So a lot of people are spending still fairly freely after all the benefits they got out of COVID and some of the quantitative easing that's been happening. But I would expect that in the future you'll find some of that discretionary spend going down, and really one of the early sectors to get hit by that is generally in the consumer space.
You talk there about being a company that likes to innovate and be agile, if you like. Does that involve the adoption of lots of tech? Obviously, that's high on the agenda at every conference that we are part of now. Why do you think that is, and do you think there are any risks around adoption of things like AI? I know you as a business use it, but where's that going in terms of investing in it?
Well, I guess if you look at the data, over the last 20 or 30 years, technology has been one of the best sectors to be active in. So for many funds in private equity, you'll find that they made their outside return generally in a technology investment. I'd probably say, if you're a betting man, that's probably going to continue as you go forward. We try to look at tech in a slightly unusual fashion again, in that, so one of the examples we did recently was we set up an early stage venture growth team, which again for a pension plan isn't intuitive. And we did that because we could see opportunity, and we also wanted to try and get some outside return, willing to take a certain amount of risk to do that. The other thing we've also tried to do is innovate around our portfolio companies. So about 4 or 5 years ago, we set up an incubator called Koru. And what that business does is it works with all of our portfolio companies and says, do you have things that you're really quite excited about, but you don't have the capital to fully exploit? In which case, you might be better off spinning that out as a separate business, and then we can help fund that with potentially some of the other shareholders in that original company. And we've done that really successfully. We've got 8 or 9 businesses now that have great potential, and they wouldn't necessarily be things you would have spotted when you made the first investment in that company. So for us, technology and innovation do overlap. It's really that ability to disrupt that we like. And I think if you look at technology companies more generically, the primary driver of their growth and their success is they've been able to displace incumbents by technology disruption.
Obviously, the other huge sort of area of interest that we've seen and an area of change has been the adoption of ESG and impact in investing. Where do you see your company being in terms of that, and how do you adopt ESG? Is it just something that you look for in the companies, in your portfolio companies, or is it something that you believe in innately in your own business as well?
I'm really glad you asked that question, so thank you. Teachers has been a pioneer for a long time on good governance, good corporate governance. And that's really how the business is overseen. For the boards of those companies, we also try to get strong diversity. So we've had for a long time in all of our portfolio companies a target of at least 30% women on boards, which we now increased to 40% as our working target. Still not 50%, but we're getting there. We also look at the executive teams and try to see diversity of thought and gender in those as well. But when we look at across the pieces you described it, we've been very clear and communicative around our ambition for climate reduction within our portfolio. So we've set out targets, which I think quite challenging, 45% by 25, 67% by 30 in terms of intensity reduction. Measurement of climate reduction is quite tricky between scope 2 and scope 3 emissions, so that's still work in progress for many investors if they're being honest. But I think the area that's really interesting is the social aspect, if I could just focus on that one. I would say most of my colleagues who work for Ontario Teachers work for us because they probably have an educator in their family, and they feel it's a great purpose to actually make returns for the community teachers that we represent. Beyond that, our own members are very clear with us that they want us, as well as making great returns for them to aid their retirement, they want us to behave in the right way as an investor around the world. And I think when you look at that within social, it's all around probably better to be a growth investor than somebody doing restructuring. Probably better to be an investor who actually really wants to serve the communities in the environment of those companies where we're present. And there's always, I think, a way of doing things where you say, I'm making great returns, I'm not maximizing returns, because to some extent you sometimes have to make that choice to be a responsible social investor. So it is really always important for us to make the right level of returns. I would always start there, it's my fiduciary duty for the plan. But I think you can also do it in the right way, where actually you build a brand where people feel that they want to partner with you because you're doing it the right way.
And perhaps the end user is actually demanding that as well.
That can be absolutely right. And that could be your entry ticket into a transaction, or actually, particularly also when you're working with governments, say, We've operated a number of projects, the National Lottery in the UK through to other important strategically infrastructure projects, where I think governments feel that teachers would be a good custodian of that asset and there would be no embarrassment for them if they were to engage us in that discussion.
There's good synergy there. Obviously, I did mention there's 4,000 of your colleagues from your profession here. It's an extraordinary amount of people. What conversations are you hoping to have while you're here, and what do you hope to take away from Super Return International?
I think when I come here, the first thing I would say is try and get a sense of the mood. And I think the mood at the moment is probably one where people are very self-reflective about ability to fundraise, liquidity for their existing assets, how easy it will be to sell them, when's the banking market really going to resume from where it was perhaps in 21, 22. Second thing we try to do is learn. So is there anything that people are doing that's different to us, and can we actually reflect on that and maybe do more of it ourselves? I'm personally quite conscious about teachers' brand. How do people see us? Do they understand what we're doing? Can I help them to understand better some of the attributes of teachers? And what makes us distinctive in a very crowded global market. And then probably lastly, I've been in the industry for a really long time. It's a great way of connecting with people I've worked with in a really cost and time efficient manner.
We're really grateful that you've come to connect with us today. Great to talk to you, Joe. Great to hear your thoughts. Thanks
Lovely
very
to
much
talk to you.
for joining
Thank
us.
you.